Day traders and swing traders and everyone who's trading. Today we will be talking about one of the most common reasons why people fail their challenges, blow their accounts, and end up being unprofitable in trading. This is referring to the risk management, one of the most important things that you really need to properly manage in order to be successful in trading. Many people really randomly enter a trade without even knowing how much they actually risk, and this is very important to know. Okay, and having a proper risk management, knowing what you are willing to lose, is something that really helps you having a clear mind, because having a clear understanding of the amount of the value that you are risking, that you're willing to lose, let's say, is very key in order for your account to grow and to see profits over the time. Profitability is not built over days or, let's say, weeks, even weeks. Sometimes it takes a couple of months to see by consistently sticking to your risk management, besides sticking to your rules, of course. If you say, I only risk 1% per trade, then do it consistently. Don't just think about, okay, you won a lot of trades in a row risking 1%. Let's say you hit a 1 to 2 or 1 to 3. And now you say, oh, you know what, I'm leveling up to 2%, I'm leveling up to 3%, and it goes on, and then there is no end. How many lots, how many pips, and whatever. Watch this video till the end in order for you to really know how to calculate your risk. So first of all, here are the basics, because knowledge is never hurting anybody. So, what is a pip? Pip stands for percentage in points. So, like if you see pip, pip is basically the standard unit used to measure price movements in Forex. Like any size, let's say, has their measurements in Forex, it is called pip. And for most of the Forex pairs, it is that 1 pip equals 0.0001 price movement, especially on the Forex pairs that refer to the US dollar. For the JPY pairs, it's a bit different. 1 pip equals 0.01 price movements in the market. You know, some brokers also have this pipette. They're called pipette. It shows an extra decimal, added to the value. What is a lot size? Lot size is very important. The lot size defines the position size in Forex in general. So we have the standard lot, it's one lot. It equals 100,000 units of the base currency. So that means if you're trading with one lot, the pip value is $10 per pip. So as I said, on most USD quoted pairs. Then you also have the mini lots, like they're traded on, I would say, smaller accounts. So there you see that 0.1 lot equals 10,000 units. The pip value in this case would be $1 per pip. You also have the micro lot for smaller, way smaller accounts, basically for people that want to practice first on their live accounts before entering, or let's say using higher amounts. So there it would be that 0.01 lot equals 1000 units. And a pip value in this case would be 10 cents per pip. The general rules here again, one lot equals $10 per pip. 0.1 lot is $1 per pip, and 0.01 lot equals 10 cents per pip. So that means the bigger the lot size, the more money you put into the trade. So we will be going over some math, but promise you guys, this is not boring math like in school. This is very important math that can make you very rich. On this example here, I use the Euro USD. Also, for the people that are more advanced, I would always recommend you to start challenges using 1%. And if you're in drawdown, please switch to 0.5. Don't let your ego destroy everything. So, what do we have here? We have the general lot size formula. The lot size you need to find out in order to set your trade is your account balance. So this is the total trading capital on your account, on your broker account, times the risk. The risk is the percentage of the capital you are willing to risk. So, like, you're willing to lose, right? Divided by your stop loss in pips. The stop loss basically is the distance from your entry point to the point where your trade would be stopped out, times the pip value per lot. So the dollar value of one pip for one lot. So on Euro USD, you can see that one pip equals 0.001 price movements. So then you apply the values that you have for your position into this formula. So let's say your total capital is 10K. You want to risk 1%, this will be $100. Step 1, we want to find out the risk. So you have 10K in total, you want to risk 1%, that will be $100, right? No witchcraft, that's not difficult. Step 2, the pip value per lot. So we know that on Euro USD, one lot equals $10 per pip. Then step 3, we insert these values into the formula. So the lot size is the risk, the $100, divided by the 20 pips times the dollar amount. So then our lot size would be 0.5 lots. Congrats, you mastered it. So again, here we have our summary. Your account balance is 10K. Your risk per trade is 1%, $100. Your stop loss is about 20 pips. The calculated lot size then is 0.5 lots. That would mean your maximum loss in dollars is 100 euros. Here are also some rules. Never adjust the lot size emotionally. Sometimes you see that when you enter a trade, it slightly goes into drawdown or it fills even 50% of your drawdown. Then guys, just let the stop loss be the stop loss, okay? You can reduce the stop loss if your trade, let's say, hits a 1-to-1 or a 1-to-1.5. There are different ways of managing your risk after entering a trade. It depends. You just have to experiment a little bit. But never increase the size of your stop loss during a trade. Just don't do it. It's a very bad habit. Just cut this out of your mind, okay, guys? Really. But guys, I know many people don't really want to calculate it manually. So there is a very nice tool for you that I actually also use in order to calculate my lot size. So let's say we're here on EURUSD and we found a nice entry opportunity. We use our short position tool, drag it here. And let's say we enter off of this FVG here after this break of structure. Okay, we put it slightly above the FVG and then we target the Asian lows. Let's drag it a little bit. So you can also put your stop loss a bit more conservative. I'm just not referring to the entry itself right now, just to give you an overview on how to calculate the lot size. So what do we see here? What are these values here? So this value right here is the ratio. As you can see, it's 3.47. That means this little box here is considered as 1. And the big box here, the green one, is considered as the ratio in comparison with the total amount that you risk. So this green part here is 3.47 times bigger than the red one. That means you risk 1%, let's say, in order to make 3.47%. The number that we see here on top, the 8.7, is the pip size. So we have the pip size. Let's stick to our 10K. And let's say we want to risk 1%. All right, there's this nice tool here. So it's an online lot size calculator for Forex pairs. It's on myfxbook.com and you can use it free. It doesn't cost anything. So we have our currency pairs here. You can choose any currency pair that you're about to trade. So where was it? Yeah, all right. So we have Euro USD. We have our account currency, it's US dollar. And then our account size, as we said, is 10K. Our risk is 1% and our stop loss was 8.7. So that was 8.7 pips. Then we click on calculate. And then we know we have 1.15 lots. It's very easy, guys. You don't have to do anything. That's basically everything when it comes to lot size, alright? So if you enter a trade, you really need to know the capital that you have on your broker. You really need to think about the percentage that you're willing to lose. I really say it, that you're willing to lose, guys, because it could happen. But if you lose 1% consistently and you make a trade that has a 1 to, let's say, like this example, guys, let's say you have a losing streak, a total losing streak. You lose like 3, 4, 5 trades in a row. I know that doesn't feel nice, but think the other way, guys. Let's say you catch trades like these 3 times in a row. That means that you're up 10%. So let's say you risk 1% on a trade like this and you lose 3 times in a row. You lose 3%, guys. Let's say you have a 10K account. Okay, then you lose $300. But let's say you have a winning streak and you win 3 of these trades in a row. Guys, that means that you're up 10%. Because if you have a solid risk to reward ratio, like you have like you catch 3.4 or 3.5 trades, then guys, you make 10%. And that's the key point. It's not about the amount of money that you lose or that you make. It's about the percentage that your account is growing while you're actively protecting your account. So guys, I wanted to make this short. For sure, I will make more videos referring to the risk and also to risk management, also to like certain ways of protecting your capital, reducing your risk, because this is also very key in trading. I hope you guys now have a better understanding on calculating the risk and why it really matters a lot and helps you to be consistently profitable in trading. If you like this video, then don't forget to subscribe and be prepared for more.